So we'll start by taking a look at the exemptions, the personal and dependency exemptions, which is this item right here. And then eventually we're going to work our way up. We're next going to look at the standard deduction versus the itemized deduction, and then the other items. The reason I want to cover this first is because we're next going to cover dependence, and I think it's important to understand what an exemption is, because whenever you hear someone trying to claim a dependent, the benefit they get, well, one of the benefits they get from claiming a dependent is an exemption amount of $4,000. So if you have multiple dependents, you can get 4,000 times the number of dependents. So let's take a look at this. So an exemption is a specified sum that reduces a person's taxable income and is adjusted annually for inflation. For 2015, that amount is $4,000. So this is something all taxpayers receive automatically. So right away, whatever taxpayers' taxable income is, they're going to get a $4,000 exemption, and that's going to reduce their taxable income. The exemptions can be differentiated into two different categories. There's the personal exemption and a dependency exemption. I'll explain what those are. An important point to make is only one exemption for each taxpayer can be used, even if a taxpayer shows up on multiple tax returns. So we'll kind of look at what that means in a minute. So the first thing is a personal exemption. So basically what it really is that the exemption, if it's used by the taxpayer or their spouse, it's going to be called a personal exemption. So as it states here, a personal exemption is an amount a taxpayer can reduce their taxable income by for the taxpayer and for the spouse. So I have names here, Michael and Jenny, because we're going to do an example later. So let's say Michael's a taxpayer and Jenny's the spouse. A dependency exemption is an amount a taxpayer can reduce their taxable income by for each qualifying dependent that they can claim. And like I said, we're going to cover dependents in the next videos. So for example, a son, if a taxpayer has a son who's a dependent, they can get a dependency exemption for that son. So in this case, let's call him Kyle. So at the end of the day, the exemption amount is $4,000 for 2015, and it probably will go up each year to keep up with inflation. However, when the taxpayer uses it for themselves, it's a personal exemption. When that exemption is, coming through a dependent, then it's called a dependency exemption. So right away, taxpayer can take a personal exemption for themselves and a spouse if it's married filing joint. But to be able to get dependency exemptions, they need to have dependents. Now let's take a look at example. A single taxpayer has a gross income of $10,000. Ignoring all other deductions for now, we know their taxable income is going to be $6,000, since the personal exemption reduces the taxable income. So as simple as that. $10,000 is a person's taxable income, and we're not taking into account any of the other deductions because we haven't learned anything else. Right away, we know their taxable income will only be $6,000. They're only going to get taxed at the $6,000 because it's reduced by the $4,000 exemption. A married couple, Michael and Jenny, has gross income of $40,000. Ignoring all deductions for now, we know their taxable income is going to be $32,000, since the personal exemption for each spouse reduces the taxable income. So in this case, if, like I said, they can right away get the personal exemption if they're married and they're filing joint. We're going to cover filing statuses later as well in more detail. So the gross income starts at $40,000. And then they get an $8,000 personal exemption, which is $4,000 times 2 to get to taxable income of $32,000. In the last example, so it's Michael and Jenny. They have gross income of $40,000, but now they also have a dependent son named Kyle. So their taxable income now, as you see, it's reduced even further. It's $28,000 because they received a $12,000 exemption, and that's calculated like this. $8,000 personal, which is $4,000 for Michael and $4,000 for Jenny, and a $4,000 dependency exemption for Kyle, who's a qualifying dependent, which totals $12,000. So as you can see, the exemptions are, very helpful in reducing taxable income, which is why everybody wants to claim someone as a dependent, because you can only get 2 personal exemptions or 1 personal exemption if you're single, and then the only other way to get more exemptions is by having dependents. And the last thing is what I mentioned before. Only 1 exemption for each taxpayer can be used, even if the taxpayer shows up on multiple tax returns. So in our previous example, Kyle, because his parents get the exemption, so because the parents got to use the $4,000, Kyle, if he files his own tax return, will not be able to use that $4,000. So for each individual taxpayer, only 1 exemption can be used. It will either be a personal exemption if they use it on their own return, or a dependency exemption if, like in this case, Kyle, when it was on the parents' tax return, it was a dependency exemption. Now, as a result, Kyle cannot get a personal exemption because he is being claimed as a dependent. This basically makes sure that there's no double dipping and there aren't multiple exemptions for the same taxpayer.